Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Dow Inc. Now, this is not the Dow Jones, this is Dow Inc. It is a chemical stock, and it's a very old company, actually. It was even mentioned in Benjamin Graham's book, The Intelligent Investor, although it's a much different company right now that has had plenty of spin-offs, so it looks very different from what the original Dow is. Nonetheless, very worth looking at in these market conditions. So, let's talk about their first quarter of 2025, where they immediately, what you see is the word challenging industry conditions. So, in general, chemicals are cyclical industries, especially because a lot of the time they have to do with industrial stuff or packaging, which when there's a booming economy, there's more industry, there's more shipping, there's more packaging. So that's very correlated with sort of strong economic conditions. There's a cycle to it. So yeah, it's important. However, here you're saying, okay, we're still delivering sort of things. We're trying to reduce our cost. We're trying to still return a lot to shareholders more than the operating EBIT. So nonetheless, they're trying to sort of show that they're a mature company that can still give back to investors, that can still operate at a profit despite hard industry conditions that may be a prolonged downturn. So immediately we see those keywords there that tell us we're going to have to brace ourselves for less revenues and less profits in the long run. Here's what they're saying. There's slower global growth with increasing macro uncertainty. Wow, that was a mouthful. So, in general, everything here is either moderate or mixed or weak in different localities, especially infrastructure, but sometimes consumer and mobility things. All those market verticals do have negative things. Look, US building permits are declining. Eurozone construction is declining. China new home prices are declining. So, yeah, infrastructure is looking not great. The consumer, so consumer confidence in the US is pretty low. Eurozone as well. US auto sales are up, but that's pre-buying. So once the tariffs come in fully, if they do, I don't know, they're different every day, then you can see a downturn, right? So all in all, there's going to be an increased level of uncertainty for them. And since they're correlated to a strong economic sort of picture for the world, and because this global economy is so sort of interlinked, then you're going to see a prolonged downturn. And this has happened before, let's note that. This happens to every chemical company where they go through those cycles, and this gives you buying and selling opportunities. So, here's the long-term view, where from 2016 to 2024, look at how these revenue numbers decline and go up by huge margins. I mean, minus 9.2% to then go up 13.4%, down 13.4%, up down 10.3%, up double digits, big time over here. So they do go through their little cycles. And 2023 and 2024 were down. 2025 is probably going to be down again. The margins, however, also see their fluctuation. They started pretty good and now they're contracting. So we also want to see those margins come up, the gross margin, the operating margin. We want to see those come up as well, or at least be maintained during a downturn, because otherwise you're not just eating the revenue, but you're also converting that less efficiently into profits. And this picture here, though, of the return on invested capital, I mean, at least they're having better capital returns over time, at least from this 1.9% in 2017, but it also varies a lot. So this is a cyclical company. This is a volatile company. That's the picture we have here, and the picture of a company that's going through a downturn right now. Now, I'm going to take these revenue estimates for 2025 and 2026, which is down from where they were before, right? Before they were at these 42.9 billion, $43 billion. Now we're saying 40.64 and 40.61 billion dollars for the next 2 years. So that's quite the downturn, and I think that's pretty realistic, honestly. And I'm going to do a discounted cash flow model with it by plugging it in. I'm going to say that their free cash flow, because it was negative in 2024, I'm going to say in 2025 and 2026 is just zero. I'm going to zero it out, and then I'm going to bring it back to sort of the margins that they used to have. So they used to have sort of these 3 billion roughly dollars of free cash flow, and that's about it. Now, then I'm going to grow it in perpetuity by 2%. I think that's about fair. That's about the rate of growth of the global economy if it's not doing too hot, which it's not looking too hot right now. And then my required rate of return, which is 11%, that's 1% more per year than the market on average. I'm gonna divide that by the total number of shares out, and then I get a fair value of $40.70 per share for the Dow. However, if we subtract the debt that they have, and they have a ton of debt, they have a pile of debt, $16 billion right there, then the value minus the debt divided by the total number of shares would give me $17.42 with net debt included. So that's what I think each share of the Dow is worth. Now let's look at the stock itself. And as you see, well, first of all, it's gone down a lot. It even touched that 70 level in 2021, 2022 when there was all this market euphoria. And then you see the slow downturn until now, where it's at this 28 level. In the past 5 years, it's crashed about 20%. You see a dividend yield of 10%, but a PE ratio of 71.66, huge. So you see a lower price than usual, but also you see a way higher P than usual. That usually means profits are low, right? And they could go even lower for now. And when the P is super high and the dividend is also super high, what does that indicate? Potentially a dividend cut. So in general, I'm very cautious with the Dow. And this is where, if you're still interested, you would look at the debt and you would see, okay, what's their free cash flow that they have available to pay it off, right? What's their interest like? How much does it eat into the operating margins that they have, or into the operating profits before you get the net profits? And then you would also sort of see, how long do they have to pay it? Do they have a revolver? Are they just going to renew it at a higher interest rate? Because that matters too. And based on that, you could choose to either ignore this post debt number and believe this $40.70, or care about the debt and go for these $17.42. So that's how it goes. And that's how it goes with a lot of these chemical companies that do have debt to fuel their growth, their acquisitions, etc. But then on the bad years, it can be really bad. So the picture here in general. So the potential of a dividend cut is very real, for the very simple reason that paying these with debts is not sustainable. And oftentimes, what you see here, for example, and I'm comparing here the free cash flow to equity and the dividends paid. So if you look at this, for example, in 2018, they actually had to take out debt to pay dividends because the dividends were more than the free cash flow to equity. But then you see the cyclicality here, where the free cash flow in general was in a growing trend here. They had much more free cash flow than dividends, even up to 2024. This may not be the case next year. And then they have to take out even more debt. So that looks very complex for their picture and for their fair value. So whether or not it's fairly valued right now can be debated, but a dividend cut often brings down the price and can present a better buying opportunity. Besides, cyclical stocks are best bought at the bottom of the cycle for their best gains. So a dividend cut could bring the price from these $28.67 to 17.42. So that's why I personally wait a little bit. And you have a fire truck out here. I hope you don't listen to that, but that's fine. But yeah, so they're bought at the bottom of the cycle. When everyone hates the Dow, that's when I would start being interested here, because they've gone down 40% in revenues. Well, that's usually when they're going to start expanding or start taking opportunities, because the economy is going to turn around after that? So, in general, doing nothing is also a choice. Here, I just wait. I just do nothing, and then just wait until there's a dividend cut, a turning picture, because I wouldn't doubt that this stock could fall another 20% from here. And then, and only then, would it be a super interesting buying opportunity for me. Now, I hope you learned something with this video. If you like content like this, please like and subscribe. It really helps me out with the YouTube algorithm. With that said, thank you so much for watching, and have a great rest of your day.